All right, how's it going, everybody? Welcome back. Feels like a Monday. So I was kind of talking with a few people, and it seems like what we've covered in the advanced or in the introduction to options seems to have left a few people behind. And so instead of going further today, I thought it would be a good time to just open up the floor and perhaps answer questions that you guys might have. It doesn't necessarily have to be about the book itself. It can be options related, but it doesn't do any good to try to continue to go forward if we're still leaving a lot of people behind. Let's get a sound check and make sure you guys can hear me. And then, by the way, the chat is working again in our live stream room. So that is going to be our #1 place during a live stream event, to have the chat in one location. We've had people that are maybe software dyslexic or just plain not good at it, using software, and it became confusing to use the website and the Discord and their broker and all of those things going on at the same time. So we're going to use the chat in the main chat room. Hopefully that doesn't confuse too many people. All right, so it's pretty much an open floor today, wherever you guys want to go. Technically, it's an introductory class, but I'm not going to hold anybody to that either. We can get as advanced as you want to go. I'm a little bit of a nerd, so I'll fall right down that rabbit hole. It won't bother me a bit. There was a little bit of talk the other day about probability of profit, and that's always an interesting conversation. When I was new, I was really struggling to wrap my head around why a trade that I built with like an 85% chance of winning would lose. And I would think, well, maybe I did it wrong, or maybe I did the math wrong or something. But those probabilities, they don't apply to a single trade. They apply to a trade strategy. And that message really wasn't kind of brought to the surface, right? When we talk, we try to highlight, key things, maybe put emphasis on certain things, I guess would be a good way to say it. And when I was learning about probabilities and probability of profit, it seemed like every education place was implying that when you built a trade, you want to check your pop so that you knew what your chances of winning were. And that's just not true at all. So it's been a struggle to try to get that message out there, that when we're building trade strategies, we may want to target a strategy that has an inherent win rate of 50, 60, 70%. But on a trade to trade basis, on a day in, day out basis, any one individual trade has absolutely no connection to that pop at all. Now, a lot of brokers are getting better about pop, but keep in mind, if you're on a broker that does not advertise as a trader's platform, you're not going to get a lot of the creature comforts that you see those of us who trade all the time have with our brokers. And specifically, I mean, like, E-Trade, for an example. It's not a trader's platform. It doesn't have all of the bells and whistles that a trader's platform would have. It's still a good platform. It's strong. It's got a lot of resources to investigate things that you may want to put money in, but it's not a trader's platform. Our Canadian friends really have a problem with what they get to choose from, and they don't really get a lot of choice. But, you know, the brokers nowadays, they are getting better. And even Thinkorswim has pop built into it. Not as obvious to find, maybe, as being on Tastyworks, but it is there. So make sure you check around on your broker to find where the pop may be located. There are formulas, by the way. There's more than one formula because different places do it different ways. I was going to be presenting all of the Tastyworks ways of calculating pop, but I had internet issues earlier today and I didn't get them all downloaded so that I could write up a nice thing on it. But when you build a trade, depending on your broker, it's going to give you your pop. So you got it right there, and it's just a guideline. Now, once you start getting more comfortable with your trade setups, your strategies, where you like to build your trades, you're going to have a pretty good idea of what your pop is, because it should be hitting in that same kind of targeted area. A lot of times it's based on how close you are to a one-to-one. And I use that number a lot. I would much rather look at what I have, risk versus reward, and then make my decision based on that rather than some arbitrary pie in the sky target number that may or may not help me out. Now, P50, on the other hand, is a lot newer of a thing, and it is more specific to the thing that you trade. So this one particular trade, this one time, has a pop of 60, we'll just say 60. So this trade has a 60% chance of hitting 50%. It's kind of neat how they did it. This is built with a Monte Carlo simulator that runs the trade like 10,000 times and gives you the likely outcome. Pretty cool. Can't mimic that, though. So the floor is open, guys. If you got questions on anything, it doesn't, have to be intermediary or beginner. It's just I wanted to backtrack and give people a chance that may have missed it to ask questions on the introductory material. It's the videos are nice. They get us where we want to be. But when new people come in and they try to watch those and then they have questions and there's nobody to ask, because we've already moved on. Nobody's got options questions. All right. Well, I guess I must be doing something right then. So every morning I do a kind of a morning summary or a morning briefing, kind of get prepared for the day, hit some checkpoints, kind of go through a little bit of a checklist. I review things like the indexes and what's moving in the pre-market, what sectors are up, why they may be up. And then, of course, we go through the calendar of events. And this morning, the topic of conversation was watch for the CPI numbers, but keep your eye on the bond auctions because it had the 30-year in the list. And sure enough, around 11, well, the auctions start at 11, and then there's another set at 12, and then the later ones today was at 1 o'clock. Surprise, surprise, we had a little bit of an impact from the auctions today. We got that beautiful little sell-off. So the Google play that we put on, and I've been doing a lot of trades that look very similar to this. I don't want to buy a call. They're very expensive. You know what I mean? Like look at Google's calls. These are crazy. $1,400. I just don't want to do that. And Google's a company that can really get some legs underneath it and make some decent moves. So then we could decide, well, if I don't want to call, maybe I'll put on a call debit spread. Okay, that's $10 wide, and it's going to cost me $500 to do this. I don't like that either. It's a 1-to-1, but I don't want to risk 500 to make 500. It's too much money to risk. And yet, if I take that same trade and I build it out of the money, well, now it's only a $70 trade. It's still $10 wide, so it has a $900 profit factor. It's only going to risk me $60 though. Now you got to be careful when you build a trade like this because your break even is very high. It's very far out of the money. When I was first teaching calls and calls and puts and was trying to explain to new traders when should they buy a call for a swing trade, and it was basically the smart answer was if you think that thing's going to get the hell up and go. And I kind of used foul language when I said it. I wanted to really, really get the message across. Like you think that the market is going to light a fire on its beep and get the hell up off the bench and beep, beep, beep. You know, so you want a market that's going to run. And if it ain't going to do that, don't buy a call. Not for a swing trade, right? Like some 14-day call option. Don't do it unless you think that thing's going parabolic. Because if it just kind of slowly grinds higher, that call's going to lose. You're better off taking a day trade or, you know, putting on some kind of spread. Well, if you're going to do a call like that, you could also just do an out of the money call spread like we built, but the same criteria applies. You don't want to do it if you think it's going to be some slow, easy grind, gentle move higher. You want to do it if you think that market's going to light a fire under its beep, hop on a rocket ship and haul butt to the upside. So we had the idea of looking at Google that it could make a reasonably decent move and that it was a breakout potential to the upside here. So we put on that Google trade. Now, it didn't need to go very far to hit our target profit. Target profits were 35%. If you get greedy and hang on to it, you know, maybe you don't get anything. I hung on to it, and where I could have closed this for $115 earlier today, now I can close it for $35. These things are just like buying a call. If you build an options spread out of the money like we did in this, short duration, far out of the money, it's going to respond with a negative gamma impact. The slightest movement in the stock, one direction or another, can kill this thing. That was benefiting us earlier when Google made that breakout that we were expecting, and it rallied up in through the morning. Beautiful, perfect. But then the bond kicked in the afternoon and dumped it back down, and now it's not profitable anymore. If we had more time, I'd keep it, but we don't have more time. This thing expires at the end of the week. So, you know, I'm not killing it yet. It's still up a little bit. I'm willing to threaten a little closer to break, even if I'm going to let it go and see what we get. It's a way to participate in a market without setting a lot of money at risk, right? Like buying a call or putting on a debit spread at the money. I'm able to participate a lot cheaper. But everything's fair and balanced in the market. And if we're going to participate a lot cheaper, then we're going to have to also take the effects of negative gamma and a move like this killing our trade, which is exactly what happened. We got punched in the head. Trade is just toast. So the good thing is, because we've gone through it before, you can go back and you can build that trade, and then you can stick it into the Analyze tab, and you can ask the question, well, what if? What if price only goes to 25.60 and it does it in a day? How much money would I make? What if price goes to 25.60, but it takes 2 days? We can look at that. You can always answer the what if. And then that helps you try to determine, well, what kind of trade do I want to put on? Now, diagonals are a funny thing. The broker won't let you develop a max profit, max loss. And the reason why is because of implied volatility. So if I go out there, we won't even use January's yet, kind of come in a little bit. If I go out there and I buy a call for September 17, and then I try to sell a call in the August 27s at the same strike, then we've just got a basic regular calendar. It's a 2550. Now, it's important to realize what we've got going on. We're using the same strike. Understanding this trade comes from first understanding what it is that you're trying to accomplish. If I just want to own a long call, I can buy the September 17. But that's a lot of money, right? The September 17 is a $10,000 option. God, dang, that's a lot of money. I don't want to put $10,000 up on an option. So I don't even want to risk that kind of money, right? Is it 10,000? Yeah, it's 10,000. Thought maybe I moved a zero somewhere. That's a $10,000 option. I don't even want to have that kind of buying power reduction. So if I was to buy this, I need to know that I've got something for a backup other than a stop, right? Because we can always just get out of the trade. But stops do a really good job of getting you out of the trade, and they will cause you loss. What if I don't necessarily want to lose? I just maybe want a little bit of help. If I buy this call, I know that at any time I can come forward in time. This is a September call. Anything before that September 17, and I can sell a call at the same strike, and it won't change. It won't increase. It will change. It won't increase my buying power reduction. This is going to take $10,000 out of my buying power. But I can sell a call against it closer in and get a lot of that buying power back. If I sell the same strike, it does not increase my buying power reduction. Shouldn't have hit, I hit the wrong button. So I can do that, no problem. And what it gives me is an option that is decaying at a faster rate than the one that I bought. These two options are going to decay at different speeds. The one closer in time is going to decay quicker than the one farther out in time. Since I sold that one and bought this one, the one that I sold needs to decay so I can buy it back cheaper than I sold it. And it needs to happen faster than this one, which it does. So then when we put the two together, this is where people get stuck. They look at this risk graph and say, I don't get it. How's that a long trade? It depends on what you're trying to accomplish. If you're throwing darts and trying to hit a bullseye, then you need price right at that 2,547 spot, right there in the middle. But if you're going to do that, you may as well just do a butterfly. It'll be a much smaller risk and probably have a higher payout, and you won't have to worry about any of it, right? If you're trying to do a bullseye, this is the hardest way to get it done. And yet that's exactly what it looks like. But think of it if we get rid of this and do it differently. Think about each one of these legs actually being their own trade, even though they form a spread. So here's our long call. And while I'm holding this long call, every single day, it's going to decay. If price doesn't move up more than the decay in a given day, we're going to be down at the end of the day, right? Every single day, it measures how much theta we lost and how much profit we gained from price action. You do the math against those two, and if one isn't greater than the other, we lose money that day. Well, if I'm trading a naked call and price stalls and we're not continuing to advance, I've got to be a little concerned. That call is losing money. Maybe I don't want to close the trade down necessarily, but I need to know that I can suffer through pauses in the market, pauses like this. To be able to suffer through a pause like that, I could decide to go in and sell a call and then buy it back later on, sell it again, buy it back later on, sell it again. Not holding a short call all the time, holding a short call when the market says I'm not getting anything out of my long call. So back here, when we dropped it down real hard. Before the drop, probably would have been a good time to sell a call, right? Because we had that breakout. It was just like these breakouts here, where we expect the market to pause and stall, and then it broke out here and it paused and stalled, and the same thing here, and it paused and it stalled. So we broke out again. That would have been a good opportunity to sell a call. If I'm long a call and worried that my long call isn't making me money or that my long call is at risk, I can keep that in my pocket. I got that in my toolbox, knowing that if I'm not making money on my long call, then I could at least recoup some of that by selling a call. So don't get hung up on the shape of that diagonal, because it's going to make you think that there's some bullseye arbitrary target out there that we need to hit in order to be profitable. When we put the two together, this is our shape. But what we're looking for is, notice I get a break even here to the downside of 2,447 when I have the short in the trade. When I don't have it, I have a break even way up here, 2,649. We're talking over $100 difference. So if Google stalls and it just doesn't seem like it's getting where I want it to go, I can add that short call. Now I've got a break even way down here. If it gets off its butt and starts running, or if that short call decays enough that I'm willing to call that profit and close it, I can take it back off. I've still got my long call. So an out of the money debit spread is just a long trade exposure with a very aggressive directional bias. It requires little capital because it has a lower expectation of winning. And diagonals, depending on how you're trying to play them, are nothing more than a way to hedge a long call. Each one of those trades that we're talking about usually has a specific strategy connected to it. So for an example, if I wanted to trade expecting a volatility crush, maybe I would want to go in and do a diagonal, or not a volatility crush, a volatility expansion. If I'm expecting volatility to expand, I may want a diagonal and actually treat it like a bullseye. But on the other hand, if I'm just trying to get long like a stock synthetic, maybe I want to own Google for the rest of the year. Maybe I really think Google's going to go somewhere by January, and I want to take a long call long term. That's a lot of money. So I may start the trade with a long call for January or March of next year. And I'm willing to give Google all the room in the world to make that end of year run. I'm going to hold it during long and shorts and earnings and bad days and bad news. I'm going to hold it for the end of the year, at least, right? Until late December, maybe even early January. And I've got to know that if I spend $10,000 on that call, that I've got something in my toolbox to help me kind of sleep at night. Give me that peace of mind that says, all right, yeah, I'm down $4,000, but I've made back $5,000 from selling these calls, so I'm really up. The time frame matters also. If we're doing something like a week-to-week SPY trade, you know, using that weekly expected move, diagonals are a really good trade on those too. Because SPY has 3 expirations in a week. So one of my strategies says, if we hit the edge of the expected move, that I go the other direction. There's really no rhyme or reason to it. You know, it's not rocket science. If we hit the edge of the expected move, I want to go the other way. If we hit the top, I want to go short. If we hit the bottom, I want to go long. We can do that with a call. We can do it with a put spread. We can do it with a diagonal. So if I buy the call and we keep falling, at least I know that I can sell a call against it. Maybe I'm going to lose on my long call, but I'll make some of that money back on my short call. And remember, the break even develops. So my long call may be, maybe I buy a 425 call and I buy it for $100. Now I got a break even of 426. As soon as I turn it into a diagonal, now I've got a break even of like 427 and 423. So I've widened out the area of what wrong looks like and still be profitable. It's just a way to cover your existing position for a short duration or a shorter period in time. But if you're literally going to play it in the shape of a butterfly, you may as well play the butterfly. They're so much cheaper. There's so much less risk. Now, every single strategy out there has these quotants that say they have a known value. They have a known win rate. And it's kind of an odd thing to try to use somebody else's win rate. That, like, I have a 75% win rate at least on credit spreads. And it doesn't matter where I build the credit spread, at the money, out of the money, it doesn't matter. 3 days to expiration, 3 months from expiration, I'm still hitting like that 75% win rate year after year across the board. That doesn't mean that credit spreads have a win rate of 75%. It means my win rate is 75%. So while there are these known quotants on each of the different trades, butterflies, iron condors, credit spreads, you're not stuck with it. Butterflies have a win rate of like 10%. That's crazy. 10% win rate. And yet, that's just some arbitrary number from back-tested research. And unless you go in and read the whole report, you don't know what the heck they were trading. Were they doing 3-month butterflies, 3-day butterflies? Were they doing it on equity products? Did they run them during earnings? No idea. So the one thing that you know that you can do is develop a trade strategy and then apply that strategy into the market. And after 8 or 10 or 12 or 20 times of doing the trade, you'll have enough statistics to be able to look back and say, well, I've been doing this trade. I've been doing it the same way every single time. This is my win rate. And the more you trade it, the more information you'll have about that one particular trade and how you're using it. See, Google's coming back around a little bit. I'm kind of glad I hung on to it. It's back up to $50. Maybe it'll get back up to that 100 and something that I had earlier. It's got time. It's got 3 days. I tried to get one for Microsoft to the end of the week, but I didn't get filled. It completely left me behind and ran away without me. But I did post in the chat yesterday to watch this. It was after hours when I posted it, but we had a red day. And the post that I sent was, hey, we have a red day in a green market in an uptrend. And a red day in an uptrend is an opportunity for a gap up like this one, right? We closed in the lower portion of that day. The next morning, we had rallied all the way back up, and we were going to open where we opened the day before. I love this setup. I don't want to do it everywhere that I find it, but I definitely love it in a strong uptrending market, which is what we had in that example right there, right? We had a good, strong trend. We had a market that paused and pulled back, which is healthy. We want a market to do that. Now, this pullback this week in Microsoft, actually in the last 2 weeks, it's lasting a little longer than I would want it to. We stalled again, right? But it makes sense why we stalled, because we're getting really close to that earnings, right? And who wants to do that? It's the same thing that happened at the last earnings. We just stalled. Maybe a good time to put on iron condor, right? Except that we sell iron condors, and that is not going to work because every day we're going to gain more volatility as we get closer to earnings, and that damn iron condor won't decay. We're going to get stuck in it. But it would be a great trade to put on, right? Because price really isn't doing anything. Now, suppose I'm bullish on Microsoft for the end of the year. That I have expectations that this thing can get anywhere close to its expected move by the end of the year. That would be around $235. That'd be $335, right? Something like that. we can look at it in the analyzer. We'll just jump this thing forward to January. All of this gray area is how far Microsoft could move between now and January 21st. And we're going to take that and set it out onto the chart. That's a fair distance away. The 330, I was pretty close in my math. So what if I wanted to trade that? I don't really want to put thousands of dollars up, right? Because one trade is fine, but I wouldn't want to only do this in Microsoft. I want to target a lot of companies. And I still want to sleep at night. So we open up more strikes and we look at the 330. And that's the high end or the far end of an expected range. So maybe we come in a little bit depending on what these cost. Here is a $5 wide debit spread for $85. It has a profit potential of over $400, and I'm only risking $85 to do it. That's not bad. I don't need to hold it all the way to expiration. But if I did, it would need to rally higher than my break even. And just to get to break even. And then anything above that would be profit at expiration. And along the way, the value of these options could change drastically. Right now, this spread is looking at two different options, both in the same expiration. And we could decide to go ahead and put the trade on, risking this $85. And what's the goal at that point? Well, we got to make back our $85. That's what we got to do so that we can hold this trade for free. One way that we can do that would be after we're holding this for, say, a month. It's had earnings at that point. Volatility has fallen. Maybe institutions come in here and sell a couple thousand more of these things, and they change the value of the options Greeks in the wave, and suddenly that short call can be rolled forward, and we end up selling that short call for more money and getting it out of the same series. And suddenly now we went from having an out of the money call debit spread to having an out of the money diagonal. And we've pulled risk out of the trade because we're trying to reclaim that $85. And there's no strategy for that. Like there's no video series on this. There's not even a name for it. It's taking an existing trade, checking your pricing, and just asking, can I roll that thing? What do I get if? That's how I ended up having long calls in GM for a credit. Technically, I didn't think that was possible until I did it. So I got that trade on. I'm going to go ahead and take it. I kind of like it. I would do one in Apple, but I've already got one. Yeah, you can roll anything really. But take this trade specifically. If I was going to roll something, the first thing that I would want to roll is that short call. I would want to get it out of the 192 time frame, this January 21st. I would want to get it closer in time. That way the short call is decaying faster than the long call. If I managed to get it rolled far enough, say I stuck it into August, at some point I could also then try to roll the long call forward. Well, no, I've got just a regular debit spread right now. It's one single trade. That's all that it is. But it doesn't have to stay that way. We can turn this single debit spread into a diagonal. So let's rebuild it, because someone's asking if we can analyze it. So here we have it in the Analyze tab. And this is for January 21st. So we want to check January 21st. We're using a 1 standard deviation. We're using in the money. And it's that gray area. If we were to day step this, it's offering a chance to put 4 lines on the chart. How far apart those lines are is up to us. Right now, mine are set at 7 days. 7 times 4, that's 28 days. Well, we are 192 days out. So only doing 28 days doesn't make much sense. Let's increase this and knock it up to 20 days. 20 times 4, right? That's what, 80? So we're halfway there. Let's knock it up another 10. We don't want to get too far out in time. We can still see we're around August right now at 30 days. Not enough. Let's go 40 days. Now we're in December. Getting closer. 45 days. January 9th. We've got January 21. Let's go a little bit farther out. 48 days. Ooh, right on the money. Now, notice what I did there. I had to set these dates to match this, right? Otherwise, those 7 days weren't going to do us any good. So if you're trying to do a day step on a longer term trade, you have to change how many steps you're using. Each line represents a step. Today's the 13th. That's the yellow line. That's one of those 4. So you got 3 lines left. We've got August, October, December, and January. I guess we still have 4 after that. All right, so it's ours plus 4. Now that white line technically is the day of expiration. So we really don't even need to go that far. We could back it up a little bit, but either one, right? Either one, it'd be fine. Now we can see the break even. Every one of these little lines has a dashed red mark. That is the break even for that period in time. It's not set in stone. That can change. It can change because of volatility, liquidity, all kinds of things can move that. But for the moment, that's where it is. So if I'm looking at this trade and I'm trying to determine, well, how far would Microsoft have to go for me to see profit by August 30? It would be this light red line. And since there's 2 reds, I'm going to change that and make it something else. We'll do cyan. We don't have a cyan color. So this cyan colored line, Microsoft would have to rally above 286 by August 30th for me to even be at break even. Now, the thing is, if implied volatility comes in, these numbers go right out the window. We have earnings coming up, and that's going to knock back volatility. So we'll just knock 5 volatility out of this thing. Ooh, not 50. 5 volatility out of it. Now we've got a break even of 294. And then we're going to knock the price up to 288. And we're going to change the date to August 1, August 2. Now we're at 296. We would need Microsoft to rally greater than 296 by August 30th. Well, now that changed too. See how everything changes. You set the tone, it gives you what you're asking for. Here's August 30th with an adjusted volatility and an adjusted price. We take the adjustment of price out. We would need Microsoft to travel up to 294 just to be at break even by August 30th. If we take that vol crush. Without it, we only need to get to 286. Now, I wouldn't keep this trade as it's built. Mainly because we're so far out of the money. If I built it at the money, I would be much more willing to hang on to it as built, right? And that's a very key piece of information. It has to come into play. So what would that look like? Since I'm already working the order on this one, we're going to kill it. And we'll build one at the money. The thing about this at the money trade that we're looking at, the money that we could make from this is no greater than if we built one for Friday's expiration. There's no benefit to going all the way to January necessarily, because this has 250 risk, 250 profit. The same amount of risk to reward 1 week out, 1 month out, 1 year out. We're built at the money. We're not going to make more than 250. But this other one is only risking $85 for an opportunity to make $400. This lower one, the one that's $253, has a greater chance of being successful, but it has less profit. And that's the balance we always have to struggle with. It's a teeter-totter between having the right amount of risk for the right amount of reward. If we decrease our risk, we decrease our reward. Right? They're connected. If we're willing to take more risk, we get the opportunity to make more reward. So we need to have trades that have some kind of risk in them, or we'll never make any money. The trick is not to get too much risk, right? There's nothing wrong with playing the lottery a little bit. You know, those have a very little opportunity to make money, but we still do it from time to time. We wouldn't want to use a lottery ticket for an income, right? It's very low chance of actually making any money. So in this trade here, which is also a January 22, 48-day step, lands us on the 21st. We got all these break evens to see. And it actually shows that we could fade backwards all the way down to 279 and still not lose money along the way. Now, once you're on the right side of these lines, you're in a theta trade. It's paying you to hold the trade. That's one of the beautiful things about being on the right side of break even. It becomes a credit. They're paying you theta. You're not paying them theta. That's awesome. When I first learned that, it threw me off because everybody talks about a credit spread being a theta trade, a premium trade. You're getting paid to be in it. Nobody ever says that about a delta or about a debit spread. And I thought, man, I must be reading that wrong. We're not reading it wrong at all. The problem is those wannabe educational gurus all over YouTube don't know what the heck they're talking about, and they just mimic what they've heard from somewhere else. So they only talk about credit because that's the only thing that everybody ever talks about as a theta trade. But if you're on the right side of debit on that break even, you get paid every day that you stay in this trade. You make the theta, which means you get paid on the weekends. Oh, yeah. MarketSmith is running a sale, $34 for 1 month. It looks like maybe it's $24. Four weeks, $29.95. That's $120 off. Man, that's a good deal. What I usually do when they offer MarketSmith is I pay the thing and then I go in and I hit their education content. Like I don't even use their product during that 4 month. Or let me rephrase it. Using their product isn't my number one goal. Every time I use their product on the trial, I target their educational content first. And then if I have any time left over, I'll use their product and go check on institutional investing, because it keeps track of whose firms are buying into different products. Like they'll point out, hey, BlackRock just, took another 1% stake in Apple, or some mutual fund took another stake in Apple. Hey, great. Good to know. But my number one goal when MarketSmith offers a trial is their education. So we're sitting here looking at this, and each one of these lines represents a date in time and how far the market would have to go to find a break even, or what number we would have to stay above to be at break even. You still want to keep in mind all the time that this is not written in stone. It's kind of like all those movies that you watch where they go into the future and they jump into the past, and the future's not written yet. You can change the outcome. You can change the outcome. You're not stuck with this, and it'll change on its own. It'll absolutely change on its own. Supply and demand alone will move the Greeks. And the way that happens is, look at the open interest. You can see that a firm has come out here and they sold 13,000 contracts in Microsoft. Now you can bet when they did that, since they increased the supply of how many contracts there were on the market, these things dropped like 10% in value. Poof, gone. Which is why it sucks when you go out here and you buy a call and you get up the next day and you're down 10%. You can't figure out why. Price didn't move. And even if price did move, they don't really affect these options that much. We know that because we can look, how much money would this option make if Microsoft moved $5? And it would make $2.50. So 50 cents on the dollar. Well, that's not that great for an at the money option. You would expect to do better than that. But it's because we're so far out in time. These options move like molasses compared to stock price. But because of the Greeks, these options do change in value. Right now, I'm holding calls in SPY for January. I went out there and I bought $50 options on SPY. I'm way out of the money. I got 500 strike calls in SPY. Now you're talking about some way out of the money junk, right? I'm way out. I'm 500 strike. So I'm like all the way out here. Now I bought these things for $50 and I've made 100% profit almost, because what I bought for $50, I can right now sell for $95. Why? Price hasn't gone anywhere. I've had that trade open for 22 days. Check the chain when I opened this trade up. June 2nd is when I opened the trade. Well, if we go look at June 2nd, we haven't really done that much since June 2nd, right? Right there. It's actually that doji, that red doji day. I bought 2 calls on that day for the 500 strike, way up here. And yet those options have made 100% profit. And if we happen to stall, get stuck, not move, I still have the opportunity to go in and sell calls against the calls that I own. Granted, I won't make much money trying to sell the 500 strike call closer in from January, but I could try. Now, when I bought those calls, it was pretty close to where the implied volatility is now. If you look at it, really, we haven't done much volatility-wise. In fact, you could say that we're even lower than where I started. Dan has a point there. Let's do this quick review because maybe some of you guys are a little worried about your longer term trades. The dollar recovered from that drop before the bonds because the dollar dropped like right after market open. The dollar opens at 8 in the morning. And so by the time we opened, it started to dump, giving it all back. It's rallied back up and it's already closed. The bonds, check that move out, right? That's where everything went nuts. It was that 1 o'clock bond move, bond auction for the 30-year. But look at the VIX. It's already started to calm down. And it wouldn't do that if the institutions were still concerned. They would buy more VIX. They're not buying more VIX. If you look at the Dow, it's still sitting inside of the range that it had before Globex. So everything's fine there. The level that I did in the pre-market, in my morning briefing, we had marked out yesterday's range. And the statement was, if we get a downside move, we should not clear lower than yesterday's low. Even if things get negative, that was our line in the sand, and we're well above that. Same thing for the ES. I had the same statement. If things got negative, we should stay inside yesterday's ES range and should not fall below it. And we're nowhere near that low. In fact, we still have the low from Globex that we haven't even tagged. So there's no fear in this market right now. The institutions aren't showing any fear. They're not buying anything up. And all of this tells us that. In fact, the dollar being bought up still implies that those foreign investors are coming in and buying more of our dollar so that they can invest into our marketplace. I still think they're going into tech, which is a part of that capital rotation. And it's why I'm willing to put a trade on in Microsoft for the end of the year at a high number that I'm trying to get filled at. Also, since we're on the talk of market breadth, because we kind of hit on this the other day, our AD is pretty close to minus 400. That's a reversal signal for a move back up. So that's a good thing. If you look at the volume on the day, this is the advancing issues versus the declining issues of the New York Stock Exchange. The declining issues is around 2,500 and the advancing issues is somewhere around 800. But we're really flat. Look at these different days and what levels we were at. And here we're just like nowhere. Okay, that's a good thing, right? We don't want to be somewhere. Same thing with the up volume versus the down volume in the New York Stock Exchange. We really don't have nothing. Look at these other days where it was like, oh, wow. But on those days, you still got to ask, well, which side is it? Is it the downside or the upside? Which is why I broke them apart here. We can see that the upside is much lower than the downside. The downside volume is greater than 300, and the upside volume is just slightly above 100. Still, this thing isn't really going anywhere. If we were negative, if they were scared, this thing would be moving like a rocket ship, right? It would look like this. It doesn't look like that. That's a good thing. No fear in the market. But there's a reason why there's no fear in the market. And trust me, it's not because they're not scared. It's because they've already bought the insurance. You know what I mean? Like, they're begging for the fire. They want the flood. They want hell and brimstone. Their insurance payment will make them a fortune if we crash. But the only way we're going to crash is if somebody sells. And none of them are going to sell because they're all holding insurance. And they're the only ones that can crash the market. So they ain't selling. And if they ain't selling, we ain't crashing. And look at this thing. This is measuring. This is measuring technology and finance combined against utilities and healthcare and defensive markets. When defense is strong, this thing is red. And when offense is strong, this thing is green. Look how green this thing is. This is a monster. Well, I mean, you know, I suppose they could, right? But they own like BlackRock owns like $9 billion of Apple. You think they want to sell that when it took them 9 months to build that position? They're not going to sell it just to get an insurance payment, right? And hedging is odd from how they hedge, right? One thing that we can look at that we haven't looked at is the skew differential. The skew is a great way to spot hedging. And we were at like record levels of skew. So it just showed that they were still hedging. They just weren't using the VIX to do it. So I got to change the style because this thing reports once a day. And that means that it's just a little dashed line. There was our record levels of skew. And that's hedging. That's 100% pure hedging right there. It's the only way we get to that level of skew is that they were hedging, but they weren't doing it with the VIX. We can hedge so many ways. In fact, we were talking about it earlier. If I buy a Google call for September, I could go and sell a Google call for August. That's a hedge. Also, a lot of those firms, they don't just go and buy a call. They would not tolerate that kind of risk parameters because they got to go to their investors and explain $1 million loss. Who wants to be the guy or the lady who has to go and tell the committee, well, you see, I thought it was going to go up. So, you know, I bought $5 million worth of Apple calls and you know what? It didn't go up. And so we're just out $5 million. Sorry about that. Coffee? Yeah. So they won't do it that way. But what they will do is they will sell calls. Excuse me, they'll sell puts and then they'll use the money from those puts to buy calls. All right. Then they're hedged in a little fashion. That's like a micro hedge, but it's still better than nothing. So there's all these different things that we can look at to try to gauge the level of fear in the market and to kind of reevaluate our risk. One of the things that I look at constantly is the VIX futures. Only I don't look at them on the chart necessarily. I mean, I do. I got them on the 6 grid, but I want to come in here and I want to look at their value. I want to make sure we're still in contango. And that contango got real wide recently. The front contracts were like $5 different than the 90-day contracts. It was extreme. Even right now, we're looking at 24. Well, let's go to January. 23.80 for the January series. It's 190 days out, $23.80. And yet, if we come into the 30-day, it's $19.85. You know, we're not even at $20 yet. That's a pretty wide differential there. That's contango. It shows that there is a lot of fear in the immediate market conditions compared to a year out or a half a year out. The investors or the firms are more concerned about this quarter than they are next quarter. That's a good way to look at it. I haven't heard the re-evaluated market targets yet, but BlackRock's target has been $600 in SPY. Excuse me, $4,600. So that'd be $460 in SPY. That's BlackRock's target for the year, $460. Only they didn't use SPY, they used the SPX. They said they have a belief that the SPX will be at 4,600 by the end of the year. And everything that they do is based on that number. The futures that they trade, the stocks that they buy, how they buy those stocks, and how they hedge those stocks. And if they believe that the SPX is going to be at 4,600 by the end of the year, it's because they still believe that we're going to have strong earnings. We're coming into the earnings session started today, right? The banks kicked that off with a bang, and so did Pepsi. I don't remember Pepsi being mixed up into the banks. I wonder why they changed their earnings schedule. But either way, we're in the thick of it, and we got to let it all play out. But so far, see, these companies, they go out and they give an earnings pre-estimate just to kind of give people an idea of where they think they're going to be. And for an example, Pepsi had already given a statement back here when they needed a little boost that they were going to have a good earnings. And of course, that gave their stock a little bit of a rally. It's all manipulation, right? And it's not bad. Don't get hung up on that word, manipulation. It's everything is manipulated, and it's normal. It's good, right? You manipulate people all the time. Don't get frustrated when it happens to you. So this rally back out was because they had already given a statement that they were going to have a good earnings. And then they had earnings, and it was good, and it popped even more. Well, all the companies coming up in the next week have, not all of them, but a lot of them have already given that same statement that it's going to be good, that it's going to be bad, that they may hit, that they may miss. Well, these institutions like JP Morgan, they record all of that, and it gets stuck into the algorithm, which then determines how far SPY is expected to move by the end of the year. And we're on target still for that 4,600 target. So when you're worried about what's going on, check the sectors, check the volume, check the AD, right? There's all those tools exist to give you a broad perspective of what's going on in the market. They're the best indicators that you could ever get. Price action. I don't think anybody could argue with price action. You know, an RSI, a MACD, a stochastics, Yeah, okay, I can make an argument that maybe it's good sometimes, but not all the time. Price is price. It's good all the time. Look at as much price as you can. We've got a horrible AD today, and the money flow is almost 3-to-1 negative, but it's not divergent. We've got red candles, we've got red issues, and we've got red capital. Now, typically on a day like this, where everybody freaks out and goes short, that's usually the day that I'm in here looking to go long. The thing is, we didn't really go very short. We only went a little short. I've been watching this watch list all day. These are things that have weekly options that are sitting in the upper portion of their yearly high. This is looking really good for a red to green, but look what it hit. The weekly expected move, and then it turned around and nosedived right back down again. Oh man, I love that. KKR broke out of the weekly expected move in a gap up in the pre-market, gave it all back again. Discover Financial tagged the weekly expected move on a Monday, no less. I mean, that's the setup right there, guys. That's the play. It reaches up there on a Monday and makes the whole week's move in a single day. Short that sucker, buy a put, run it back down again. It only costs you $20. I can sleep at night risking $20. You know, $200, maybe not so much, but $20 is nothing. Can't even go to McDonald's and get a Frappy for that. AMAT. Look at this. Beautiful run up off of the lows, higher highs, higher lows. We've built these base, built the base, built the base, another base. Now, IBD would say that this is actually one base, right? Because it really didn't get anywhere. So this is like in their count, the first base, the second base. A second stage base breakout is what we're in right here. So we kind of missed the boat. We wouldn't want to get into it now, and it's right before earnings. But look at that run up, right? And it's the same trade setup again and again and again. I shared a picture of my Fidelity account the other day, and somebody made a statement of, damn, it looks like it just went straight up. Like you didn't have any losses. Well, of course I had losses, right? Everybody has losses. But they weren't very big losses. I was able to just cut the loss and move on because I wasn't trading very big. And yet that account, that thing is just gone and made some pretty decent money. Where did that thing go? Now, it's a longer term account, and I haven't really done any options in it yet. Where I stuck that thing. Yeah, there it is. Now, a lot of this has been mutual funds, but not all of it. When IBD gives me a heads up that there's a breakout in something with good, strong fundamentals, the breakouts that they focus on are things on a daily chart coming out of a base like this, just exactly like AMT here. It stopped in this run up, kind of flagged a little bit, and then it broke out. And they will put on an alert first saying, hey, it's in a buy zone at these levels up here. And it'll tell you when it gets there, it's going to be a buy. So then once we get in it, then you scale up. You let it go, I don't know, a good 5 weeks, 6 weeks. And if it's still above your break even and it's making you money, then you add more, and then you add some more. If it keeps running, you add some more, and you keep scaling in. But what are you risking? Profit. You're not risking more capital out of your account. And then if it starts to fall back down and break key levels, then you scale out the same way. You close some, not all. Close a little more, not all. Until it starts to get close to where you got in, then you end up closing the whole thing. So that's how those returns that I have in that picture came about. It wasn't doing fancy stuff with options. It was just buying into stock as it was breaking these levels. That account does have stock and options capabilities, but I haven't done any options in it. Options are higher risk. That's my longer term account. I don't want to risk that account that way. So if you find that you're losing more than you're winning and you're doing nothing but options, maybe try to do a little stock buying. It's a lot less forgiving, or it's a lot more forgiving. Let's say it that way. That makes more sense. Now, guys, you don't have to go buy some IBD investing, thing. Every major broker out there, heck, even Robinhood has articles and publications that can point you in the right direction. So there's the 1 year history, right? And there are drawbacks. I don't just straight up make money all the time. I lose like everybody else, but they're managed. You don't just close your eyes and, hope it's all going to turn back around again. Shop, UPS, Tesla, Target, PayPal, Morgan Stanley, Microsoft, Apple. Really big names, strong fundamentals, coming out of key levels, And on the total loss side, I started to try some of these high dividend companies. And I don't have very many of them, like 1 share here and 1 share there and, 3 here. They're my biggest losses, trying to get some dividend growth stocks. Yeah, they may be paying a good dividend, but their stock is junk. But, it's a long-term account. Let's see what them come back around a little bit. The rest of these are all in the green. Total gain, right? Then they're not big numbers. Hey, this one made 15 cents. Doesn't matter. I can sleep at night because I don't have too much risk on. Let it grow. It gets around $10 in profit. I'll go buy another $10 of it. What am I risking? Profit. What's the worst that's going to happen? Apple's not going to fall to 50% off, not unless the whole market burns. Yeah, I mean, I try to spread it out. You know, I don't, I'm biased. I know that I'm biased. I really like tech and I really like finance. I need more like retail and stuff like that, which is why I added Target. I need more shipping, so I got a little bit of UPS. I need more diversification, but I'm working on it. It's a struggle for me to want to branch out that way. I yeah, I don't have much healthcare, and I want to get like a one or two utility companies in there, maybe like a green energy or something. The thing is, with that connection of correlation, if 3 out of every 4 stocks are going to crash, if the market crashes, it won't matter how diverse we are, they're all going down. You know what I mean? Like that it won't matter how diverse we are at that point. Diversification for me is profit, not risk management. And I say that because when I was learning more about trading, a lot of places kept hammering that drum of stay diverse, spread your money out, keep it in, go into different sectors of the economy. Man, when we crashed last February, it didn't matter where the hell you were. Everything lost money. So that whole drumbeat of diversification for risk management is crap. It ain't true. Everything went down. Precious metals, gold. The only thing that didn't go down last February were the hedges, right? The VIX models. But in the recovery, they kept saying, oh, it's so hard to try to figure out what's going to recover fastest. And that's why you need diversification. We don't know what's going to go to the moon, right? But they've got those targets of 4,600 for a reason, because they expect a lot of things to go to the moon. Well, if you don't know which ones, and maybe you're like me and you're not deep on the investing side, you haven't done a lot of research in maybe half of these names, we got to diversify and get into as many names as we can. But we still got to be able to do it without overloading our risk. So to me, diversification is a way to spread out my opportunity for profit, not a way to hedge against a crash. It took a long time to get to that point, though, because I kept trying to do it the other way around. I kept trying to find ways to protect myself or to protect my accounts. At the end of the day, I just use the hedges now. And for me, the hedges can be something as simple as selling an option. I've got these Apple trades on. I don't have any short calls. This short call is a part of a call spread, but I don't have any short calls right now because I already closed the last one out. I've got my long call, and if Apple doesn't get off the bench after its earnings, I'm going to go in and sell another call again. But these things, I'm just letting them do their thing. Right now I've got these 3 combined on, and I'm showing minus $22 with all of this risk. And that's all that I've got, as a loss. And that's benchmarked against the profit that I've already had in it. And that's on this account. So, yeah, I'm still in PayPal. I haven't closed anything down. I didn't want to react to this move in the market, even though, I mean, I know that PayPal was barely profitable this morning when I was posting a picture. It was up like $8. And now I'm almost positive that it's down probably 40%. This move in the market wasn't a surprise. We already knew that we were sitting on the edge of a disaster with that bond auction. I record them every morning. I go in and I run a pre-market analysis, right? Like a market briefing. And I literally talked about, watch that 1 o'clock bond auction. It's going to be a game changer. You got to, like, it's not a surprise. that we had this move today. The thing is, I can't just sit on the sidelines every day waiting for those kind of things. Otherwise, I wouldn't have the Google trade, right? Or I wouldn't have anything. So even though I knew there was a lot of risk, I still went in and put on a trade anyways. And I don't know, it doesn't look like it's doing too good at the moment, but it's a strong fundamental company. And I'm keeping it at the moment. I kind of wish I'd have gotten it a little bit longer, maybe, but yeah, it gave back the $10 that we were up, and now it's down 24 on the day. But I still have it. I don't want to get whiplash. So someone was just asking about a book by John Carter. I've been referencing him a lot lately, and John Bollinger both. Bollinger, I was reading his book about the Bollinger Bands, and he wasn't really complaining. He was just kind of like, you guys are using it all wrong. And so he came out with this other book kind of restating how the Bollinger Bands are supposed to be used. And to me, I kept reading in between the lines. It really seemed like he kept saying, you're using it wrong, and quit complaining that it isn't working for you because you're not using it the way that I designed it to be used in the first place. It's a good book. But the book that I was just asked about is Mastering the Trade. Guys, if you're looking for a book, the first place to go is to the web. Seriously, like, there's just so much free stuff out there. And again, these books that you can find on the web, the author doesn't get anything when you just go download something on the web like that. If you use his book and develop a trade strategy, it starts making you money, go buy the guy's book. You know what I mean? Give it back. Put it on your coffee table or something. Make it a conversation piece when people show up. Um, hey, if you read it and you don't like it, fine. Don't buy it. But if you get something out of it, give it back. I don't think I read that one because it looked like the third edition. I'm probably gonna go and check it out, see if there's anything in it. I may like it. Look at that. We got a Busby forming on Amazon. We're inside this shadow candle here with a massive pin bar. Man, I don't want nothing to do with Amazon. None now. So what I've gone and done is I started gathering up price patterns beyond what I normally use, using it more of a perspective of the way that IBD and TD Ameritrade present in their webinars. And the way that IBD and them do it, especially TD Ameritrade, man, they zoom in tight like this. It's hard to get used to at first, how zoomed in they are. You know, I'm like, you can't see anything. But the thing is, they won't even look at something if it already doesn't meet their credentials, right? Their criteria. So take Amazon. Looking at it from here, we could be at the bottom of a range. You know what I mean? Like we could be at the bottom of a barrel, but we know that we're not because we just saw it on the higher time frame. So then they're looking at this zoomed in chart and they're only paying attention to the smallest amount, this right here, and making a trade decision that might last 2 days or 2 months. And so from this, we got this shadow candle and this pin bar. Well, if we go and look at, you know, pin bar logic, they got like 4 main pin bars. Inside bar, pin bar combo pattern. When you combine a pin bar into an inside bar, you're getting both a setup that is going to be released and a pin bar with a tail or shadow that shows the next potential direction of the market. Aha. Yeah. Now, if you're hearing this and thinking, damn, what? I didn't know anything about that. Each pattern out there has books and webinars and video presentations, not necessarily made by us. We're only, you know, we're only one group. We can only make so much content a week. But Lucian went through the price patterns. He wrote a book. It's on the website. We got like the desktop wallpaper and everything. When you start putting these things together, they form a picture. You know, you start to get a trade bias off of it. We literally have this set up right now on Amazon, right there. At the way. Pin bar, bottom of the range. Yeah, double pin bar. Inside bar, pin bar. Inside pin bar combo pattern. But notice it was already in a trend, stopped, consolidated, got the inside pin bar combo, and then continued the range, the trend. Where to get in? At the close, at the nose, or at the retrace. So the measured move from the 50 SMA. When it comes to doing technical analysis, the funny thing is that we can actually measure price action, and a market that's doing good should contain itself within a measured move. If it starts to break that measured move, it actually starts to warn us that the market isn't doing so good anymore. right? Like it won't meet its requirements of a measurement. Moving averages are very similar to a magnet, not because it's drawing price in, but because if we get too far away from it, it wants to come back, right? It's that same discussion of like a pendulum clock. A pendulum clock goes left to right, left to right, left to right. Price goes up to down, up and down, up and down, up and down. And it doesn't matter if we're going higher or going lower. It's going to be higher highs and higher lows, or lower highs and lower lows, but it's still up and down, up and down, up and down, up and down. So if we get too far away from a moving average, we're coming back to that moving average. Now, the trick is what moving average, right? And what time frame. There's an old school logic for doing technical analysis that says start from the left side of your chart and draw a line to the right side of your chart and connect price. Well, my lines just suck. It's all right. We got it there. A simple line like that from left to right shows us our bias, right? There's our trend right there. And even from something as simple as that, we can say, well, how was the trend? Is it steep? Is it narrow? Did it, was it a slow decline or a sharp incline? What did it do? Well, there's our absolute low to our absolute high, and there's our line in the sand. To be able to determine what moving average we would want, which moving average is going to look the closest to that. Because what this is the mean. It's the average. It's the middle. If we were to add up the price of every one of these candles and then count those candles and divide what we added by the number of candles, we would get this dot plot linear regression line, just like that. It would be very, in fact, it'd be better, right? Because that's why I said this is the old school way of doing it. Back in the day, they didn't have fancy drawing tools like we do now that'll just calculate a linear regression for you. You know what I mean? Like 50 years ago, they were just happy to have a computer that connected to something. So back then, they just drew the line. Nowadays, you would be way better off actually using the linear regression line. But one thing that I like about these old school tricks is everybody can do them. When it comes to linear regression, maybe you can't do that on some brokers, or maybe you wouldn't understand that if I only had 6 months showing instead of 1 year, that the regression line would look completely different, and that'll throw people off. So this doesn't really require much education on understanding it compared to a linear regression anyways. So the 50 line, it's not perfect, but it's holding the same slope from way back here and from here. So we could say when we get too far away from this yellow line that I drew, we come back. And we can say the same thing about the 50, that if we get too far away from the 50, we come back. The problem with the 50 is in a good, strong market trend, we might not revisit that 50 until sometime next year. Well, that doesn't do me any good. I'm kind of looking for a trade today, not next week or next year. So the 50, as strong as it is just too far away. The 20, on the other hand, is a lot closer in. We tend to revisit that 20 more than the 50. And if we get too far away from the 20, then we tend to come back to it. And we can kind of zoom in and see that. Well, not that close. We can kind of zoom in and see that. When we get too far away from that 20, two things are going to happen. One of two things. It's either going to pause and wait for the 20 to get caught up with us, or it's going to turn around and come back and meet that 20 halfway, right? It's going to go back to it. And we can see it play out again and again and again. So we get too far from the 20, we come back to it. It's actually a short-term, short trade opportunity. And your destination is back to the average, like a magnet. You can measure it, right? You can, because if we're running a measured move, if a market is in a trend, why I'm stuck and can't think of a good, clean, strong trending market right now. There we go. AKR. So in a good, strong, clean, trending market like we got right here, even this still demonstrated those effects. We get too far away, short it, run it back to the moving average. The trick becomes, well, what is too far? How far is too far? Obviously, this was a blowout move because of earnings, and it got a lot farther away than we would want to see a market go. But this one here doesn't seem to be too far. We can draw that line, and then we can copy it. And the next time we start to stretch too far, we can set it in place and say, did it go the same distance as last time before it turned around and came back? No, it went farther. Oh, we're outside the boundaries. We should be looking for a reversal here. Not there. Not there. We got too far away there, and we turned around and came back. We didn't make it all the way back. You know, it found some support on the 10 instead. But everything that is moving in a measured move should continue to run that measured move until the market gets broken. And they use that language at IBD and stockcharts.com a lot. They'll say, oh, well, we were looking at a market, but it's a damaged market, or the market was severely damaged today. You'll hear them use that kind of phrase quite a bit. And that's what they're referring to, that, you know, those meme stocks, for an example. AMC, I was trading this thing last year, doing like, you know, selling puts and getting stock and selling calls, because it wasn't a crazy market. It wasn't extreme. It was a good, clean, nice market to trade. And then this stuff happened. Well, it's broken. When it did that, it got broke. The chart was damaged. We couldn't even do technical analysis on it anymore. There's nothing to measure because it literally broke all of its extremes at that point. So we couldn't use something like AMC and do a measured move. But on a market that is behaving within its fundamentals, you should be able to go in and apply measured moves to it. Just keep in mind, a market that looks like this is not going to have very good technical analysis. You're not going to want to trust a lot of the measurements that you get on something that looks like this. Mainly because of moves like this. But also because it's sideways and it's just crisscrossing those moving averages. Now you get something that looks like Google, and you start going in and doing a measured move, then it's got more applicability. Just remember, moving averages are not support and resistance. They look that way. They make us believe it. Hell, we even talk that way. We'll say, oh yeah, it found support here. But the only way to validate that is after it did it. If you see it coming down to a moving average, you can't trust that there's going to be support there. You wouldn't want to trade hoping that it's going to be support there. You would only want to look back later on and say, see, it found support there. And that may sound silly, but you got to carry the narrative, right? We got to be able to describe and discuss and analyze what it is that we're looking at. It drew back to its mean. Well, that just confuses people. Oh, it drew back to the 20. It pulled back to support. Yeah, that doesn't confuse people. It's a language that they understand. Now, I talked about the SPX and measuring things the other day. And if you take something like the SPX and you start to get into the smaller time frame, you can measure when we get too far away from a market and then literally watch us revert back to that market. The only danger comes in when it makes that move and then goes even more, when it just continues to go farther and farther and farther away. Tom Sosnoff from Tasty Trades went all around the United States as a crew. The Tasty group went around and talked about their aggressive contrarian trade strategy. And that's just a fancy way of saying they were looking for a market having moved too far, too fast away from its moving average. And when it did that, they would go in and short it. It sounds great, but they shorted Apple in late 2019. How do you think that went? They shorted Tesla in late 2019. How do you think that went? Not too damn good, because something that's strong can stay strong, and they got ran right the hell over. It worked on a lot of trades, but it didn't work on every trade because nothing works all the time. So one thing that you can do in Thinkorswim that's kind of neat is you can build your own indicators. So we can go in and build something like this. What was the overnight change from yesterday to today? You know, at $3.56, it was 0.8 of a move from year to year. We can also do the same thing. How far away is price from whatever? And there are indicators even inside of Thinkorswim that will measure like how far away price is from an indicator, or how wide the distance is between two moving averages. MACD, by the way, literally measures the distance between two moving averages. That's literally what it's measuring. Now, I could have swore I built one just the other day that actually was measuring how far away SPY was, or the SPX was, from a daily indicator. I went in and used something like the daily time frame, which is what these lines are. Make sure we turn everything else off. So those three lines are the daily moving averages, the 10, the 20, and the 5. When we get too far away from the 5, I start paying attention. I mean, the 20 is great, don't get me wrong, it's fine, but I want a more immediate trade, which means I'm going to use a more immediate moving average, the 5. I came to that conclusion by looking at a 1-year daily chart with a 5-period moving average. Look at how SPY reacts, or the SPX, excuse me. Look at how it reacts to the 5-period moving average. So when we're above it, I'm looking for a long trade. And when we're below it, I'm looking for a short trade, unless we get, quote, too far away. That's a very arbitrary thing, I know. Just, well, what's too far? How far is too far? My measurements over the weekend was 0.5%, and that comes up to around $20. If we get $20 away on the SPX from the 5-period moving average, I'm looking for a reversal. If you flip that over to SPY, it would be around $2. If we get, past $2 away from the 5-period moving average, you should be looking for a market to either pause or reverse, or both. Pause and then reverse. So there's my 5-period daily moving average. what would it look like if we stretch it out and put it on a lot of days? A lot of days, like in the last 30 days. It starts to make a cleaner picture. You know, we got quite a bit of ways from the market right there. It literally pulled in. Now, of course, it rallied out anyways. But on that one day, it came back, right? And then it continued to move the next day. We got too far away there. Hard, sharp, fast, immediate reversal the very next day. Pulled right back down to it. You don't have to try to use this for a trading trick or for a trading opportunity either. You can use it for evaluation purposes, which is what I tend to do in the mornings when I go in and do my morning briefing. I'm not looking for a trade necessarily. I'm looking to carry the narrative. Are we near that 5 period? No. Okay, we're not. Where are we? Are we above it or below it? What's more likely? Which is how I approached it this morning. We were sitting way up here at last night's close. What's more likely? That we're going to get yet even farther away from that 5, hold the line, or come back towards that 5. It makes determining what we're going to do on the day a lot easier to wrap our heads around, right? It's a lot easier when we got a binary choice, up or down, you know, instead of sitting there with a bunch of technicals and RSIs and MACDs and all that, all this other stuff. Are we above or below the 5? Yes or no? And if we are, how far? What's more likely? See how much easier that is to kind of make a trading decision about. Now, remember, 3 out of 4 companies follow SPY. So if I believe that the SPX is going to hold the line or even reverse back on the day, I'm not going to be looking for a blowout trade opportunity in a lot of different markets. Also, with measured move, it literally means exactly that. So on a day where we are making good, clean price action, where it looks almost like a computer is doing it, it's because it is. You can go in and measure something like a pullback. And the next time we start to pull back, you can put that measurement in place. Are we getting more aggressive or less aggressive? Well, this didn't pull back as far as it did last time. That's more aggressive. Trend is going to continue. We can grab it and move it down here. Did we pull back the same as we did back here? Yeah, almost to the dot. Okay, well, we're still in a clean trend, but it's less aggressive. You know, and then the next pullback, did it pull back more or less? More. All right, well, that's less aggressive because the sellers lasted longer and they were replaced with fewer. Flip that around. Yeah, the sellers didn't step back up as quickly. For those that locked in gains and got out, others didn't step up to the plate as quickly on this pullback as they did on this one and on this one. So you can use measured move when a market is moving in a consistent fashion. You just can't use it on something that looks like that, right? There's nothing there to measure. So when you've got a trend, you can measure. I got to change the color of this thing. When you've got a measured move, you can measure the pullback. And then the next time it starts to pull back, you can set that measurement up there. And you can also measure the next impulse up. So when it makes a move up, you can copy it, and the next time you get a pullback, you can set it where the pullback starts, and it gives you your next target to the upside. It's literally measuring the movements of the market. And then if the market doesn't pull back as much, that's more aggressive. If it pulls back even farther than it did before, that's less aggressive. And then on the impulse move up for the next leg, if it doesn't travel as far as it should have, that's a warning. It's less aggressive. If it travels way too far, that's a warning. It's a blow off top warning. Too aggressive means a bunch of retail traders have decided to come in and they're going to blow the market out of the top, and the institutions are going to sell it to them. But we can't use measure to move everywhere. We can only use it when there's actually a measured market happening right now, which is why trend days are so amazing to do measured moves on. Once you get used to doing that on a trend day, you'll have a lot more control over your trade, because you'll be able to quantify, is that pullback really just a pullback, and is that next leg up a blow off top, or are we actually reaching out to our next target? And Visa is one of those that really didn't do a good job on its measurement. Yeah, Disney, that's a good one. You mean like counting the legs? I don't know of any number that would be appropriate. You know what I mean? Because I guess it would depend. I would say the answer has to be no, because I've seen penny stocks have like 8 legs in a day. The distance would still hit something like 4 or 5 T. So now see, and that's a big distinction. You have to distinguish index products from equity products. So SPX or SPY, QQQ, ES futures, those are way more mean reverting than anything else, and they're more algorithmic trading than anything else. Trading being the word, not investing. Because see, when the firms pile into BlackRock or X Steel or USO, they're putting billions of dollars in it and they want to keep it. When they get into the futures, they might be in it for a minute or an hour. So their charts are beautiful for trading, and we want to approach them completely different, which is why, like, I do a lot of my work on the SPX, so that for those of you who don't trade futures, we can still look at index products. So if we go and look at something like Disney, this move here towards the end, blow off top. I mean, I'm surprised it didn't crash and burn going into the close. But let's go back and like measure that as it was unfolding on the day. So if we had this and suddenly it breaks out, we went from a range bound market to suddenly no longer being in a range. It is the very start of a trend. We don't have a real trend yet because we just left the range, but we've got higher lows, equal highs, and now suddenly we've got a higher high, higher lows, and higher highs. We've got enough information at this point, we could snap a fib. The argument could be made that we could use this line, this candle, since that was where the first pullback is, right there. An argument could be made for that one or the next one. If we were live in the market, this is what I would have measured, because it's literally the first minor pullback, right? So that is where I want to snap my fib. our target would be the 1, 2, 3, 6. And we're looking for how far does it pull back and how far does it move up. A pullback shouldn't breach the 618 and close underneath it on this time frame. It can wick down, but it needs to come back inside and close above the 618. I read it a little more strict than that when I'm actually in a trade rather than analyzing a trade. If I'm in it, I don't want to see it wick below this, wick and close below the 786. But analysis and being in the trade are two different things. So there's our pullback. We're looking for another leg up. We get there. We got to pause and stop and say, it should have stopped here. It didn't. It's a little bit of a warning. Now, we don't have to jump out of every single trade as soon as we get a warning, but this is a warning. It was supposed to stop there and it didn't. A couple of reasons why it maybe didn't. Maybe we should have used this other candle. Okay. I mean, I can argue that, but I didn't want to use it. We wouldn't have used it if I was live in a trade. I wouldn't have used it. But that would change where our 1, 2, 3 is. And the other reason is this started trending or breaking out right in the middle of lunch, and that's not normal. That's a big heads up that something ain't right to begin with. So not a surprise if we actually get to our target and we go past it. So it's a little bit concerning, but I wouldn't bail out of anything. And I would still be looking for my pullback, which we got one. If this thing just kept running and it didn't pull back here, I'd really start tightening up my stops. But there's our pullback. Now that we have that pullback, we're now valid to move the Fibonacci forward. The argument can be made that we move it where we were supposed to put it, which would be right there. That's what I would like to do because that was our target. That's where the next fib should go. However, you can argue that using the other candle was fine too. The reason I'm showing both is you want to find what works for you, and neither one of these are wrong. I've even had people tell me that neither one of them are right. I make money with mine, so I like it my way, but try both and see which one you like and then stick to it. Don't continue to use both. The number one thing you want to do is find some consistency, however you do it. So we got our number marked. We've got our next target in line. We're looking to make sure that it does not pull back, quote, too far. So we got a little weakness here. Nothing to be concerned about because it barely got below the 100 and never got close to the 786. And for me, since I watch price action, it didn't breach this pivot minor. I would be okay to stay in it. I may even be looking for an add-in at this point. This is concern. We didn't hit our target. Now, at this point, I would be asking myself, did I have my Fibonacci in the wrong spot? It's possible. Sometimes we don't know. Remember, we started on the first breakout. It doesn't hurt to move it around and ask, if I had used a different fib location, would it have worked better? I backed it up to here instead of here, and it lines up perfectly with that expected move and that pullback. So an argument could be made that this is a better location rather than having it down here, which is where we started, right? From there, we went to here. It failed to hit this number, and it pulled back. I would be a little concerned, but since the whole darn thing started late, as long as we're above my break even, I wouldn't get out of anything. We hit the target. I would expect a pullback. I don't want to see this thing go parabolic through that level. And we didn't. We got there and we started pulling back. All of this is a slow grind. Our trend is dead. It's been dead. It's a slow grind. We are getting higher highs and we are getting higher lows. But this is like just nails on a chalkboard. There's no power here, no juice. It's like retailers trying to pile in and make this thing move. Definitely not institutions. So we did get to our target. We can move the fib up yet again, and that gives us our next target. Along the way, weakness, weakness, and again, weakness, but this one we was expecting to see. This one we were not expecting to see, and this one we were not expecting to see. All of that indicating more slowdown, more weakness. If I'm in a single call in a day trade, I would have already bailed out of this thing. I would not have held it because I was looking for a market to continue this trend, this good, strong trend that we had, and it's not doing that. But it got our target, which means we can move up the fib again. And now we have another target. And a huge red flag pops up because we hit that target in a single candle in an explosive move. And we got this real long pin bar. And all of this can be connected to the time of day also. We're in power hour. Anybody that was trying to short this thing are now buying it back. And it was such a slow grinding dog that I bet there was quite a few traders trying to go short against this thing. And they're all buying it back, trying to get out of their positions by the end of the day so they can be flat into the close. And then you got the MOC and everything else. Now, in all of these measured moves, they were all just slightly not right. And yet you could still go in and measure, say, this impulse. Obviously, the next one went a lot deeper. That would be the one to use. But at the time, you'd start with that because that's all you got, right? You got to be fair. You can't cheat. So if this is the one that we would find the next bigger pullback, that invalidated the little one. We throw the little one out. We got the big one. You can take it and move it to the next time we get a pullback. From the top of that candle, right there, we would set it in place when we got a candle close and ask, well, how far back is it going to go? It pulls back to there. That's a higher time frame line. I have to go out there and look. Institutional pivot point. Major level. Well, the thing is, when it comes to a trend day, a trend is, I mean, like the very definition of trend is measured movements. If you was to go into the CMT book and read about trends, and that's exactly what they'll talk about, measured movements. And one of the biggest warnings that you can get when you're trying to trade a trend is that it no longer performs measured movements. Or even when you are in a trend live, that it's not making measured moves. The impulses are out of line. The pullbacks are out of line. All those things are telling you, hey, man, this thing ain't acting right. The pullbacks were too shallow, or they went too deep. And then the next impulse up was too short, or it went too far. All of those things are screaming at you, watch out. This thing ain't acting right. And they are supposed to act right. They went back and did analysis on markets from like the 1800s. They found a stash of documents of market participation from back then, right? Just recorded trades in journal form. Well, they plotted that out. And even back then, when people didn't even know what other people were doing, the markets still made those movements. That literally tells you it's not the chicken and the egg argument, right? Because back in the 1800s, Joe didn't know what Bobby was doing, and Bobby didn't know what Billy was doing. So they weren't looking at each other's charts and plotting out measured moves, and yet the market still moved in a measured fashion. So when it isn't, it's a warning. It's a heads up. If you're in a trend day or trading a trending market or in a day trade, and that sucker ain't moving the way it's supposed to move, it's like alarm bells going off. Watch out, man. This thing is acting goofy. It's liable to fail on you at any moment. Keep your stops tight. Don't rely on hope. Be ready to bail out of that thing. I do. I have very specific criteria for a trend day because there's a difference between having a trend in a day or having a literal day called a trend day. You can't quantify one until after it's already happened. So if you're looking for validity, that's only going to happen after the day is done. And you can look back and say that was a valid trend day. But you can spot them before they start, and you can start to trade them even before they're valid on the assumption that it's met all the criteria and that you are in a trend day until it proves you otherwise, which is how I tend to approach the market. I will make a determination like, it's a trend day, prove me wrong. And I will wait for the market to prove me wrong while I'm in the trade. So for an example, is that a trend day? Well, I don't have enough Globex showing yet, but what we have on the chart, just this says yes. It ran until 11 o'clock and it paused for lunch. And that was all that we got. Sure, we had one more little impulse. That's really common. You see that very frequent at the end of lunch that we get one more little push, and that's all we get. That's a trend day that stopped at lunch. One of the criteria to be able to quantify that is literally that it did stop at lunch. But we had lower highs and lower lows all the way to lunch. That it began trending before 10 o'clock and that it left the Globex range. Well, I can't say for a fact that it left the Globex range because I can't see back any farther. So where was that day? Right there. This is what I literally teach, that we want to trade these days when they appear. And we can't state for a fact, at like 10:15, we can't call it a trend day at 10:15. We don't have enough data, but we can damn sure be in it and be making money through the whole thing. And then looking back after the trade is done, say, yes, all the checks on the checkbox were done. I took a trend trade. It followed through perfectly. And I got out right before 11 o'clock or right after 11 o'clock, just like I was supposed to. And all I left behind was this little bit of money that I didn't get. All right, well, at least I got the meat of the move. One of the criteria to have a trend day is that you're not inside of yesterday's price. You're not inside of Globex price. There's a whole checklist of things to spot a trend day before the market actually opens in the morning. And it used to be better. Let me rephrase that. It used to be more accurate compared to the way it is now. But a lot of it is based on volatility. So before the virus crash, we didn't have as much volatility. So when volatility actually did show up, it was like, aha, we got volatility. Now, every day's got that volatility. So we really lost some of our mojo on picking a trend day before the trend day actually starts. But that doesn't mean we can't do it. I made a video on trend days. It's on the Bullish Bears YouTube page. And there's a checklist and everything else that goes with it. You get up in the morning, you do your morning routine, you go through the steps. What happened while I was asleep? What happened to the other markets around the world? What was their economic reports? What are our economic reports? Any major news? Where's the futures? Is there a gap? And then we get into the open, we get into the first hour, the second hour, going right through the checklist. Boom, 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 boom. How likely is it that we're going to have a trend day? And we used to spot those with about an 85% accuracy, that we could call it at like 10 after 5 or 10 after 9 in the morning and say, load up, guys, it's going to be a trend day. Buy and spy at the open. Now it's not 85% accurate, but we just have so much volatility now. It's a lot harder to do. There are still big neon flashing light that stands out when we're going to have a trend day. We get a lot of accuracy when everything lights up. It's like, oh man, take your pick. Everything's going up today. You know, and you get out of stuff maybe you've been stuck in for a while, and you know, you take some day trades and load up. Friday, I posted a picture of the SPY with trend day analysis attached to it. If you want to learn to trade a trend day, you have to know what the heck it looks like. This is the very definition of a trend day in all of its glory and form. Well, everything repeats, literally everything. It's the reason that patterns work. A trend day is a pattern. It's no different than a head and shoulders or cup and handle, a flag, a pin bar. It is a full pattern. So if you want to trade it, you damn sure have to be able to recognize it and then match all the key criteria. What did it do at the open? What did it do by 10 o'clock in the morning? What did it do? Where did it go? You know, what are the other markets doing? How do I prove that this is a trend day? What do I, yeah, all that checklist comes into play. And by the way, I called Friday's trend day before it started. So that's cool. How about that Friday? Afternoon trend day. And those also have unique criteria. Afternoon trend days are a thing. There's 4 trend days in total, 4 trend patterns, very specific, very detailed, unique patterns. The good thing is when you're wrong, you're able to get stopped out short. You know, you don't have to like hang on to them all day. You'll know pretty fast, like, uh-oh, that's not a trend day. And you know, you're done with it. You're out of it. Globex checklist, pre-market checklist, the open checklist, 1 hour, 3 hours, because that gets you into your lunch hour, power hour, the close, the time sequence, what to expect, and what is a trend compared to what is not a trend or a trend day. Like that. That's not a trend day. No. Sneaky, but it's not a trend day. This is not a trend day. So you got to be able to quantify what it is. And that often starts by pointing out what it's not. This is not a trend day. This is not a trend day. It is trend. It's beautiful trend. It's tradable. It's trending. It's beautiful, but it's not, quote, a trend day. So the easiest way to be able to develop a trade strategy around this is to go find examples of what it is that you do want and definitely what it is that you don't want, and then start measuring them. Maybe use an RSI or a MACD or stochastics. I'm certainly not against it. Those are great tools to do measurement. I was looking at the money indicator on the CCI the other day, and when you dial that thing down to a 5, anything above the 0 line is bullish on the intraday. That's pretty interesting. It's not to say that you would run out and take a long trade just because we get above the 0. No, that's not what I'm saying. But I would certainly look to take long trades if this indicator is above 0. That's what I'm saying. And that's a nice measurement. You know what I mean? Like that's a nice heads up. It's nothing fancy. It's just measuring the market. Or trading a 50 line pullback in the RSI. But anything above a 50 would be bullish, and anything below a 50 would be bearish. So when we're just maintaining below the 50 all day, you're looking for short trades all day. Why? Because we're below the 50. It's a way to quantify where are we at below the 50. Oh, I guess I should be looking for short trades today. And this is the SPX. So if it's short today, so's 3 out of 4 markets today. Guess I'll go look for something short. And then it crossed above the 0 line, or the 50 in this case. So then it's, okay, well, I guess we're done taking shorts. Maybe we should be taking long trades. Nothing wrong with using indicators. Anything that you want to trade, you got to be able to articulate what it is. I hear people tell me all the time, I'm going to be a day trader. I want to day trade. Okay, what are you trading? Options. No, seriously, what's your criteria to get in? Oh, I don't know. I want to find things that are moving. I'm going to trade that. That's a really good idea. Find some price action that you want to trade. Find out how to spot it. When does it show up? When does it not show up? What does it look like when it begins to fail? What warnings can I attach to that to perhaps know to get out of the trade? That it's done. I can get out. I'm not going to leave too much meat behind. You will. I will. Everybody does. But, you know, if you can capture the meat of the move most of the time, find it, quantify it, write it up, take pictures, measure it, and then try to prove yourself wrong. I was watching a webinar the other day from Peter Davies. Davies is the developer of Jigsaw. That's who Peter Davies is, and he's done a lot of educational content on using like order flow products and things like that. It was kind of interesting. He was kind of a rude a little bit, and he said, "Well, if you've been paper trading for he had some number. it's time to go and trade live. And you could tell he was like talking to somebody in a chat that we couldn't see in the video, because his next answer was, well, if you've been trading, for whatever time frame and you're not profitable yet, just quit and give your money to a trading broker. It's like, damn, that's cold. He was trying to prove a point, though, if it kind of got lost in the shuffle, that if you keep trying to trade different things and you never master anything, you're not a trader anymore. You're like a professional chaser. You're just chasing the next product. I don't agree with his assessment, by the way. I'm just saying this is a guy that literally built a trading program based on flow and develops educational content for a living. And he was flat out telling somebody, well, if you're not profitable by now, just stop. You're not going to make it. You're done. Quit losing money. Quit wasting your time. That's some cold stuff right there. Try to keep your education linked to something. So for an example, trend days. Well, a trend day needs trend. So does a flag, by the way. So does a cup and handle. So, if you took one of those and went into the next thing and then went into the next thing and then went into the next thing, your education's connected. You're using one thing to develop a trade, develop a logic, and have a strategy. And then you build on that into another strategy, and you build on that into another strategy, right? And everything grows. Your accounts grow, your education grows, your knowledge of the market grows. But if you're literally bouncing from like order flow to RSIs and then candle patterns, and it's all disjointed, and a lot of it isn't going to connect together, and it's going to confuse the heck out of you and leave you starting right back where you started at the beginning. So in that same video that he was talking about having a thing, he said, watch the market. Now, this is something I've heard before. Watch the market without a bias. Don't paper trade it. That'll give you a bias. Don't have don't pick a side. Don't be, don't be bullish. Don't be bearish. Try to pick a company that you don't care about. That might sound funny, but like, I like AMD, and I don't even have a good reason. I just like AMD. So I care about AMD. I wouldn't want to do it on AMD. Pick a market you don't care about. Don't pick a side. Don't paper trade. Just watch. Just watch the market. And he said, watch it for a week. Watch it for 2 weeks. And just look at the price action. How does it move? What kind of a behavior does it have? What's its average daily volume? Can you detect algorithmic movements? Which is kind of funny because you can only look back and see them. But he said at the end of that week or 2 weeks, did you see anything that you really liked in that trading behavior? Start recording it. Start writing down that behavior. It does. You're not building a trade plan. You're pointing out behaviors. Say X Steel has a behavior of opening, running for the first half hour, and then dumping and reversing 100% in the other direction. That's a behavior. If you can point out a behavior and then start quantifying how often that behavior happens, can you develop a trade based on the behavior that you've identified? Maybe yes, maybe no. I mean, nobody's saying you have to, but it's literally how you would approach developing a trade strategy. Finding a behavior in the market and then literally asking the question, how could I make money on this thing that I found? The reason it's so powerful is because if I build a trade strategy and I give it to you, it won't do you any good. I use a lot of tools you've never heard of, or you don't have exposure to, or you're limited in because you haven't gone through the content that I have. So my strategies just handed to you like in my playbook, they wouldn't work. You wouldn't trust them when they were working, and you wouldn't trust them when they didn't. You wouldn't stay in where you should. You wouldn't get out where you should. You wouldn't ignore the signals when you should, right? And that's the problem you're always going to have picking anybody's strategy up off of the shelf and saying, wow, this guy's been killing it. I'm going to go do what he's been doing because he's been making some money. I love trading this thing. It's like one of my day trade favorites. And I lose probably 3 out of 4 when I do it. And I'm okay with that. I'm totally fine with that. I lose 3 out of 4 times when I trade this thing. And I'm totally happy with that. No problem. It's not about the win rate. Not when it comes to X Steel. It's the moves, man. This thing has legs. Look at this. The very definition of a trend day, by the way. And it ran all the way to 11 o'clock. So he did have an interesting point that if you can quantify a behavior and recognize it on your own, and then you start to develop a strategy around what you found, you will personalize it. It will be yours. You'll own that sucker. One of the reasons that I advanced so fast in trading was because I didn't try to mimic what I learned from somebody else or what I saw somebody else do. I would take their idea, like Dan was doing the ride the 9 a lot when I first got into the bullish bears. I mean, that was his jam. I hate that strategy. I hate it, but it's a money making thing. Like if you go do ride the 9, that's a day trade strategy that will make money, hands down, way more than it doesn't, right? I hate that strategy. Doesn't work for me. Yeah, right. Once you're in it, I hate the whole damn thing. And yet it's a great strategy. But instead of using the 9, I use the fib. It's the same thing. It's keeping track of a measured move in the market as it's trending. Because if it's not trending, it's going to break that 9. Well, if it's not trending, it's going to break the Fibonacci. Same difference. I just don't like the moving average. And rather than trying to make the 9 work for me, I just said, you know what? Screw that damn 9-period moving average. And I went and did something else. But I wouldn't even have looked in that direction if I hadn't seen Dan doing it, right? So I didn't just try to go out and mimic what Dan was doing. I just took what he was showing and built on it in something that worked for me. These half-day breakovers, I use a 5-period 50 moving average to spot those suckers turning around in the market. Sometimes it's too slow. The 34 will work. But the good setup that I found on a nice midday reversal after a low, not a high. For some reason, I'm biased against the high side on it. Is watching for a market to cross that 50 on the way back up. On a 5-period, 50 moving average, a good drop. Usually it had been a drop on a day like this, but the 50 was too far away for that day. It had dropped too hard and fast. The 34 would have to work instead. There's Dan's ride the 9, by the way. Well, a 10 instead of a 9, but it stayed underneath it the whole ride down. Had your warning on the break here, and then it was just done for there. I use a 34.50 a lot, and I've always got a 10 on somewhere. See, there's the 34 break. Perfect. No milk, water. Remember they said water, not milk. We can watch it. But see, instead of using the moving averages, this is the failed flag. So I can throw those things right out the window and say, oh, there's my failed flag setup. All I got to do is break that 786 to the upside, and it's game on. Well, you know, Namita, it's kind of interesting. I was really tore up on moving averages. They were driving me crazy. I need some consistency, you know, and I wasn't finding any. So I went on a little bit of a rampage hunting for, quote, the right moving averages. After a lot of research, I found sources that I trust, right? It can't just be like Bob's YouTube page. Stockcharts.com. I really trust them. And when I was going through the moving averages on the CMT book, exponential moving averages react to a market move very fast. So if you're using a big moving average number, an exponential is going to be more responsive. So a 200 period moving average or a 100 period moving average, those are going to do better in an exponential because they will turn faster. But the easiest way for you to try to figure out which one you would like better is to turn them both on. Now, I'm not talking about trading this way, by all means, no. But here's my simple, and here's my exponential. And just to keep them apart, we'll make one of them dotted lines and the other one not dotted lines. And now we can compare the two. I got to turn this back into a regular one. You want to look at both of them and ask, all right, well, which one is doing what I need it to do? Like, what are you trying to accomplish with a moving average? And then that helps point you in the right direction. If I'm using moving averages to identify where the mean is, I want that mean to be steady, and I want it to read all of the candles fairly. A simple moving average reads all of them fairly. Nobody gets special treatment. But an exponential moving average is going to pay more attention to the closest candles and give them more attention. So it's more responsive. And on a bigger time frame, in a bigger number, exponentials are more commonly used, like a 200 exponential moving average. I used to spread things out that way. I would have like the 200 exponential, and then I'd have like SMAs in the lower numbers. And I really wasn't finding a lot of inconsistency in the difference between the two. And I finally got to the point, it's like, what's it matter for the way that I trade? They're both doing the same thing perfectly. And I quit trying to differentiate between the two. I just finally said, you know what, unless I have a very specific reason, I'm not going to use an EMA. I'm only going to use an SMA. But there's even more than those, right? There's self-adaptive moving averages. They'll literally change their own number. You just turn those on and they do all the work themselves. I don't really like them, by the way, but I mean, you know, they respond to volatility and their number will increase or decrease depending on that volatility. That's fine, I guess. And then there's other ones that will do like the whole average or Wilder's average or a more weighted average than the exponential. And then you can get freaky with it and start doing the high-low close divided by 3. And if you're looking for trades on the intraday, I'm going to get off here and go hang out in the kitchen in a few minutes. But check this out. This is something somebody pointed out a while back, and I've been loving it. Take Dan's ride the 9 strategy. Instead of using a close number for your 9, use the low, because you want to know where the low of the average is, right? Think about what we're talking about. A moving average is showing you the average price on the day, where the middle is, the mean. Well, if we're in a trade and we're trying to find weakness in the market, we want to be warned when a market starts to fail. We want to know where the low edge of the mean is, not the middle, right? So we don't want the close price. We don't want the high-low close price. We want the low price. So if we go in and we set price action to the low, when it does the formula, it's showing you where the low end of the average is, not the middle of the average. Now, the difference between that and a simple moving average, this is a 5, so I got to change it to a 10. And we'll make it a different color and make it dotted. Now we could tell the difference. So there's a regular 10 with the dotted line, and there's the low 10 in the solid line. It's just a little bit lower. If we do it the other way in a market that's falling, it's just a little bit tighter. So something to think about. If you're going to use it to identify a trend that begins to fail, you don't want to know where the middle of the average is. You want to know where the low of the average is. There's no wrong number for a moving average, by the way. A 10, a 5, a 9, a 20, a 34, 50, it doesn't matter. But if you're stuck between the two, turn them both on. Turn them both on and go back and look at a price action that you wanted to trade and ask, would this have solved my problem? Would it have helped me out? Did it show me what I was looking for? Oh, I'm a total nerd when it comes to moving averages. I spent 9 months reading books, watching webinars, going through and applying them on my charts and just scrolling back, looking. I've wrote strategies on Thinkorswim from the strategies section and then applied them to different time frames to see what low was too low. You know, how does a ride the 9 work on a 1 minute versus a 5 minute? How does it work on a 15 versus a 5? Which one is better? 9 months spent doing nothing but moving averages every day. Every time I had 30 minutes, I would come in and turn on a chart and find trend. I had a whole list of stocks that had trended in the last 5 days, because you can use Thinkorswim and look at a tick chart 5 days back. And you can see trend on a tick chart even when there really was no trend at all, just to have a trend to analyze. So by the end of that, I had a really good idea of what I did want and what I did not want. And it's often easier for us to say what we don't want, right? If you think about it, you've never had to ask anybody, hey, do I like this? I promise you don't ever seek anybody else's opinion on what you do not like. You know, do I like these shoes? I don't know. Do I like meatloaf? Ah. You'll know what moving average you do not like if you go and try to use it for a little while, or even just go back and do research, putting it on a chart and looking at it. At the end of it, you'll say, you know what? I looked at that 5. I didn't like it. Great. You now know you don't want a 5. Don't use it. Make sure if you go in changing your moving averages around that you put them back when you're done. Color code your moving averages. And then pick something. Color code your moving averages. Pick a pair, a single digit below 10 and a double digit less than 50. And then pick something like a simple and an exponential. Run both of those side by side for back testing and research. Bring up every single kind of trend that you can find and compare them to each other. Which one is representing it better? And then whichever the one of those that you stick with, and it should not be done in a day. It should last at least 6 weeks of comparison. Going back and looking at things and doing that kind of thing for 6 weeks. At the end of that, whichever wins, simple or exponential, start looking at the whole moving average against something like the weighted average. Or a whole and Wilders, right? Take simple and compare it to Wilders. Take simple and compare it to the whole. There's webinars on all of these, by the way. I don't necessarily say that the Bullish Bears has webinars, but there's been books written, videos made. Stockcharts.com is a great place for education on indicators. It's always my go-to resource. And just compare them, see which one fits you better. And remember, nothing is going to work all the time. So you're not looking for the solution, right? There's no holy grail. But you will find after a while what you do not like. And then there's a time and a place for everything. So like when you're on the yearly, those moving averages may not be the same ones that you want on an intraday. I've gotten really comfortable with 3 numbers, and 3 is really the sweet spot. You need at least 2. 3 is good. 4 starts to get into too much. It's like right on the boundaries of too much. And then 5 is just crazy. To me, it's the 10, 34, 50. And that often can mean 5, 20, 50 or 10, 34, 50. One of the, whatever combination is that I like. 50 is my constant. And I've heard of people who go in and do some kind of Fibonacci mathematics to try to figure out how far apart their moving averages. I don't. Maybe that's something you want to look at. I don't know. Same thing with time-based charts, setting your chart on like a 78. I don't know. Sky's the limit, right? But find a pair and apply them and just start looking back and start asking that question. Is it doing what I want it to do? Is it showing me what I want to see? And think of it as a tape measure, because it's measuring the market for you. It's not supposed to be a trade signal. It's not, entry and exit signals. It's supposed to show you momentum and trend, the strength of momentum, the strength of trend, trend weakness, trend failure, warning signs. That's what you're looking for, not support and resistance, and certainly not entries and exit conditions. You can use them for warnings, and you can use them for entry alerts, exit alerts, right? But just because we breached the 50, I wouldn't close a trade. I would look to close. I'd be ready to close, be asking if there's any darn reason left in the world that I should stay in it. But I'm not going to close just because we breached the 50. Once you develop a trade analysis based on moving averages, then you're going to be good to go. But you don't want to have to write a book. You may find, however, that writing the book will get you your consistency. All right, guys, I'm going to get off of here. It's breakfast for dinner, and that means we work together in the kitchen to make sure all the good stuff gets cooked and hot at the same time. We got a tag team dinner. You guys have a good evening. We'll be doing it again in the morning because it'll be my day on Wednesday. We are going to be using the live stream room for our chat. So real quick, sorry about the double screen here. I'll get it scooted over. This chat is back again. We're going to be using this. So, you know, I was only kind of halfway looking at it today, but we're going to have to get back into the habit of using this. And it'll take a few days, you know, before everybody gets normalized and we're back to looking on this one screen. But this is going to be the chat in the live streams. I'm going to try to do better tomorrow, definitely, of keeping my eye on this. So that's the game plan. We'll be in the morning to do what we do all over again. And, you know, hopefully we get a nice rebound from this pullback. I do love a red day when we close in the low of that day, especially in a trend. And that's exactly what we've got. So I'm excited about tomorrow. I think tomorrow could be a lot of fun. Be careful, everybody. See y'all tomorrow.